What's up guys, welcome back to InvestingPH. So if you have watched recently one of my latest uploads at which we tackled 5 undervalued stocks, now we will dive into 5 undervalued stocks with good dividend yield. But let me just make it clear, when I look for dividend companies, I don't just choose the highest yield alone. No, it has to be a strong company that has growing earnings and of course has potential to grow more in the years to follow. Anyway, I discussed this in one of my videos, the 5 biggest dividend investing mistakes that you should avoid. So if you want to watch it, there's a link below. With that said, let's start. Before we start, time and time again, I would really appreciate it if you would be kind enough to hit the like button for the YouTube algorithm. And of course, if you still haven't subscribed to my channel, now is the time to do so. Moving on, our first undervalued dividend stock is Asia United Bank or AUB. Bank stocks was really affected by this pandemic. Now let's have a quick look at their financials. But before that, I will be concentrating on different criterias for bank stocks in this quick preview. Since a bank's financials are really different compared to other industries, their financials are complicated, and valuing some of their ratios using standard range wouldn't be much of a use. But anyway, the first thing I look at is their income statement, at which their net interest income and non-interest income. Now, net interest income is the income they get from the interest from their assets, like the loans they give out. So what we want here is for this to be growing per year, at which we can see AUB is growing this consistently for the past 10 years, even amidst the pandemic. And for non-interest income, this is from their other activities like investments, trading. So for me, what I want is for net interest income to be the one higher. So if we add these two up, we get the bank's revenue before provisions for loan losses, at which is growing every year. Now, I want you to take note why I showed you revenue before provisions. You can see each year, the revenue and revenue before provisions only have a slight difference. But in the COVID years, they really went high for provision for loan losses. Now, this is cash set aside by banks to allow for uncollected loans and loan payments, at which in the COVID years, a lot of loans may not be paid. That's why banks had set aside a larger amount of cash to compensate if ever this happens. With this, their revenue dropped even though their net interest income and non-interest income got higher. Almost all the banks did this during the pandemic years. Anyway, it's important for you to know this because it's the biggest reason why bank companies had a decline in their revenue. Moving on to their net income, we can see it has been growing consistently pre-pandemic. But again, due to the large loan provisions, a decline in 2020. Still, even with that, their compounded average growth rate is at 13.39%, which is really good. So with this, we can see AUB's revenue had really grown pre-provision, even amidst the pandemic. Moving on to their equity, we can see it has grown quite well this past few years, growing at a compounded rate of 15%. Now, one thing I also look at in banks is their ROE. This, I compare it to other banks when I evaluate this because ROE tells us how well the company is using equity to produce net profits. With this, AUB has a 5-year ROE average of 9.8%. This is well within industry average if you look at other banks' ROE average. For the company's dividends, they had been consistently increasing it since 2017, except of course in 2021, wherein their dividend payout was the same with their 2020. For their price right now, they have a dividend yield of 4.55%. Next is the price-to-book ratio. This I look at more instead of the price-to-earnings for banks. AUB's price-to-book ratio is only at 0.66. That means we are buying the company's book value at only 66% of its price, or we are buying their equity at a discount. A ratio less than 1 indicates the company is trading below the value of its equity or book value. With that, for this ratio, the company is really undervalued. Now, for their debt ratios, banks have somewhat higher debt ratios since in the company's financial statements, cash deposits are considered a liability for them. This greatly increased their current ratio and debt ratios, which is a common thing for bank stocks, so we won't dive into these ratios for our bank stocks today. For my computed intrinsic value for them, it's at 68.8 with a 30% margin of safety, having a buy below price of 48.21. Our next company is DMCI. Now, DMCI stock price has somewhat recovered this past months, so for those who have bought it during the peak of the stock's downturn, not only are you gaining big dividends from them, but a huge capital appreciation as well. A quick look at their financials. Revenue of the company has slowly grown along the years, except of course in 2020. But look, the revenue in their latest 12-month has already surpassed pre-pandemic numbers. For their net income, same story, although huge fluctuations in some years, especially during the pandemic seasons, but their latest 12-month has well recovered. Their 10-year compounded average growth rate is at 7.77%. For the company's equity, it has been growing consistently ever since 2010. Their compounded average growth rate is at 12.06%. For the company's FCF, we can see they always have a positive FCF only in 2012 and 2014 where they had negative years. As for the company's debt ratios, their debt-to-equity ratio is sitting at 0.98, so well within our criteria here. And for their current ratio, they have 2.37 pesos of current assets for every 1 peso of current liabilities. So what I want here is for this ratio to be above 1. For the company's dividends, their dividend yield as of now is at 6.16%. Now, I didn't include their special dividend this year since this payout doesn't happen usually for the company, but if we included that, their yield would be as high as 12% for the current price right now. So each year, they pay out this amount, but again, in some years, they pay out special cash dividends. Now for what they are showing here, I don't know why Morningstar doubled the 0.48 payout in 2021, so I think that's an error for their website. So don't mind the other 0.48 cash dividends. Moving on, my computed intrinsic value for the company is at 11.40, having a 30% margin of safety. My buy below price is at 8.02. Next up, another bank stock, China Banking Corporation or CHIB. Same as AUB, their price has been stagnant for quite some time now. A quick look at their financials, their net interest income has been growing well every year, especially this pandemic. So was their non-interest income. For the revenue, before provision, like we've seen a while ago, it has grown quite well. Now even after provision for loan losses, China Bank still has increased growth in revenue, which is really good. If you look at their net income, although in 2010 to 2014, they didn't quite move much, 2014 onwards, they had really grown well even amidst the pandemic, growing at a compounded rate of 12.27%. Now for their equity, they had been growing consistently over the years as well, with a compounded growth rate of 11.98% over that 10 years. For their ROE, their 5-year ROE average is at 10.4%, which is slightly higher than AUB a while ago. For the company's dividends, right now, with the current price, they have a dividend yield of 3.95%, and we can see they had been consistent in their payout as well and actually growing them along the years, except again for 2021, which had the same yield as their 2020. For their price-to-book ratio, it's only at 0.64, so we are paying less for their book value or equity. So for this ratio, this company is really undervalued. And as for my intrinsic value for them, my computed intrinsic value is at 42.17. Having a 30% margin of safety, I have a buy below price of 29.52. Next on my list is Double Dragon REIT or DDMPR. Now although it's still new and as you may have noticed, it's lagging behind compared to its other REIT friends. Now I see DDMPR has a lot of potential to grow in the future. And of course, while waiting, I get good dividends. Now a quick view of their financials. Since this is new, we only have 4 years of data for us. Total revenue, we can see 2020 was a decrease for them. Well, this is not a surprise for the pandemic years. For their net income, same story, grown the previous years and in 2020, a negative growth. Now other REITs as well, like A-REIT, had the same story for the COVID pandemic years. It really took a toll on real estate companies. As for their equity, they had been consistently growing even amidst the pandemic, even in their latest 12-month. For their FCF, the company always have a positive FCF. It only decreased in 2020 as well. For their debt ratios, their debt-to-equity ratio is only at 0.23, which is really low. And as for their current ratio, they have 3.27 pesos of current assets for every 1 peso of current liabilities, which is another good ratio for them. For their dividends, they have a dividend yield of 5.23% for the current price. Now for REITs, we really need to take into account their occupancy rate since their earnings greatly rely on it. Now for their latest quarterly report, DDMPR's occupancy rate is at 97.71%. This is for their 3 properties. And of course, we also need to take note on their future projects because this will grow more their earnings and of course, give us investors more dividends. For the DMPR, their Double Dragon Tower is at 94.08% completion. And as for their Ascot DD Meridian Park, it's at 19.67% completion. With that, we can see there are more properties to be added to their portfolio. Now for my computed intrinsic value for them, it's at 3.39 with a 30% margin of safety. My buy below price for them is at 2.23. Last on our list is PLDT or TEL. Now, although this company is still far from their glory days back then, I see the company now recovering slightly. So this, maybe, you would add to your watch list of dividend stocks. Quick preview of their financials, their total revenue has been somewhat stagnant, really slow growth from them, but slowly picking up pace 2019 onwards. Their net income, on the other hand, we can see a different story. The company hasn't yet recovered past their 2010 earnings, which is a very big X for us. But again, the company's pride paid for this already. Their price had been lagging for years now, but 2017 onwards, the company is slowly recovering. This is why TEL had gotten into my watch list because of this recovery. Although it's still slow, it's still progress for the company. Now for their equity, it's quite stagnant ever since 2015. Now we will see later why this had been stagnant. As for the company's FCF, like what we've seen in their net income, they are quite all around the place. Now for the company's debt ratios, their debt to equity is at 3.90, which is quite high. This is why their equity has been stagnant for quite some time because the company is stacking up debt to help grow the company. Now this kind of ratio is somewhat normal to their industry since Globe also has a high debt to equity ratio, which is at 4.19. As for TEL's current ratio, they have 0.34 peso of current assets for every 1 peso of current liabilities, so another off the standard ratio for them. But if you look at their competitor as well, Globe also has a low ratio for this, 0.68. So for their industry, I think this is quite the common scenario. For their dividends, their current yield right now is at 4.82%, and they are consistent in their payout and slightly increasing it as the years goes by. Now for my computed intrinsic value for TEL, it's at 2,426.85, and with a 30% margin of safety, I have a buy below price of 1,698. So quite a tight margin for you to buy since right now, TEL has already exceeded this price. Its price right now is at 1,700, but maybe its price would go down again. Now some of you may not like the financials of TEL as of the moment since the company is still recovering. This is the only problem for this company since you are betting for them to continue this recovery and someday pass their previous earnings. So with that, this ends my 5 undervalued dividend stocks. Now this is just a quick summary of these companies, so please don't just rely on this video. Still, do your own research and analysis before you buy. With that said, if you liked the video and still haven't clicked that like button up to now is the time to do so. So thank you and see you in the next video.